Resolution of inherent risk at a level of financial statement. NDA, sorry, Canada of Auditing 315. Identifying, assessing the risk of material misstatement through understanding entities and its environment. Risk of material misstatement at the financial statement level refer to risk and related pervasively to financial statement as a whole or potential effect may assertion. The risk of material misstatement that's a wrong that may arise under financial statement level in the financial statement refer to risk that related pervasive to financial statement. That risk is very high that may affect the financial statement as a whole or potentially affect many assertion. It's not only can be a whole, single whole, all the things are potentially may affect many assertion, many things they may affect. The risk of the nature is not necessarily risk identifiable or specific assertion at the class of transaction or account balances or disclosure level. This risk which may arises from class of transaction, account balances, or some specific transaction that is sales, purchase transactions, so husband's account, like some retires, some creditors, some expenses, that kind of transaction, account balances. The balances like inventory, contingent liability, that balance or disclosure level. As per the NDAs, they need to disclose something and they have not disclosed that event. Rather, they present circumstances that may increase the risk of material misstatement at assertion level, for example, through the management override the internal control. So this kind of increase in risk from a material misstatement adds up wrong in the financial statement. At assertion level, in this level, what's the example they are saying is the management may override the internal control. How the overriding the internal control will increase the risk? Example, there is an policy of one person accounting, other person checking. One person making the entry for payment, other person authorizing the entry for payment, authorizing the entry for payment, other person making the payment. There is segregation of duties. If the duties has been totally overridden, a single person, the total organization control has been given. He has a right. He has a make a risk. He may give some error. That kind of problem may create. Financial statement level risk, inherent level risk, financial statement level risk may be specifically relevant to the auditor's consideration that risk of material misstatement arising from fraud. Yeah, so the management may use the financial assets or financial, they can increase the valuation, or they may use the misuse the asset. Many cash can be not been accounted. Any sales has been misaccounted. This thing. The audit risks are considered at the financial statement level during the audit planning process. When the level of when the risk arises in the financial statement, well, when on the time of planning itself, because the auditor need to forecast this problem and plan accordingly. If you don't forecast this problem and if we miss it in the planning level, the risk arises at that point itself. At the time, the auditor should undertake the overall audit risk assessment based on the knowledge of client business, client industry, management, control environment, and operation. How he should plan by knowing the knowledge of the client business, knowing the industry knowledge, and knowing about the management, know how this control environment of this management works and how they operate. The auditor need to understand this, then he should make a plan. Such assessment provides preliminary information about the general approach to engagement. The auditor staff needs a framework within which the materiality and audit risk assessment can be made in at an individual account balance or class of transaction level. So by understanding materiality should be increased. Materiality means like we need to audit these small accounts, and if some small thing we no need to consider. Example, the account balances below 500, need not to allow these balances are not material, not a issue. As per this organization is 10,000 crores, so 500 rupees is not material. Such a way need to say. So the materiality will determine. Based upon that materiality need to be revised. Even the balance account need to revise or transaction level need to see. So we are saying only transaction. When you're sampling, we are saying 10,000 more about transaction, 10,000 to 1 lakh. We are taking sample size of 100. But due to the some statement we found in the financial statement, we increasing the sample size from 100 to 1,000. So this is in the statement level. Sometimes in we are seeing the balances of what tires balances we are seeing. While seeing the balance we are seeing, so it is materially we are saying the balance is more than 1 lakh is we need to see less than 1 lakh it's not material we are saying. And we are taking sample law, we are saying every balance, we are leaving the other balances. But when we find that some debtors is being fictitiously been, there is no sale, but that is a debtors balance is there. Now we are changing it from account balances not 1 lakh, we are reducing to 50,000. Such a way, this is this statement level, a class of individual account balances or class of transaction level. Assessment in current risk, auditor use professional judgment to evaluate the numerous factors, example, integrity of management. So to assess the inherent risk, auditor uses professional judgment. What are the judgment is used? An example, integrity of management. This the management is true, or they are loyal to the company, or they doing fraud. Management experience, knowledge, and changes during the period. Its inexperience of management may affect the preparation of financial statement of the entity. So, what is being knowledge? What knowledge they were saying? Auditors know. Management knowledge. Do they know the business? Do they know the NDAs? Do they know the accounting? Whether they are the proper knowledge to conduct the business, or whether they are following it. That is not see. Unusual pressure on management. Whether the management is being forced on pressure. If pressure is there, we need to account. We should see the pressure. How this pressure affect the goals and how this goals has been affecting their result. We need to find the nature of entities balances nature of entity business. Example, the technological obligation of the product and services. Complex capital structure. What is a technology? Sometimes you see the business of the business. Example, now the Chinese has brought into a new AI DeepSeek. So, but if you are doing audit for US company, you need to see how they are allocating the cost, how these companies are allocating the cost. And you see the technology of the US company you are auditing, are they going to be obsolete? How is going to differ? You need to we want to see complex capital structure, how they are bringing on the investment. The investment is authorized by the board. Sometimes these companies may get loan from loan sharks. Whether what they are doing, significance of related party and number of locations. What are the related party? Who are the parties in the company who are probably giving any contracts? Who receive the contract? That you see number of location. Where are the location? It's an example. If the company is now in aliens or any enemy of India, then that companies we need to see this is a location. It is significant risk for us. Bangladesh is significant risk for us because they are going against Indian policy. We need to see through it. Significant related parties and number of location, geographical spread of the production, and factors affecting the industry factors which the entities operates, the economic and competitive conditions and changes in the technology. How the technology changes, what is the competitive condition? These are all the things you need to see.